Hello everyone, I'm Shekhar from Momentum Lab. In today's video, I'm going to talk about wealth allocation framework. Now, so far in our previous videos, we have focused mostly on the science side of investing or the quant side of investing. But we believe investing is not just the science, it also has an art component. Now, in this video, we're going to focus on that aspect. The key component every investor or a DIY investor would face is how do I allocate my assets between different components? That's a key question that many people have, and there are some heuristics on how to go about it. But we wanted to present a holistic framework which helps clear a lot of the doubts and also plan not just on few assets like equity, debt, or gold, but also the larger perspective. Let's say if you have a residential home, or if you have a plot, or you have a business, or you have some ESOPs, how do you allocate all these different assets into one single framework? So that's the whole essence of this video. And to drive home this point, I'm going to take a couple of research papers and two books. So I'll just quickly show you what are those research papers and books. The first research paper that I'm going to talk about is written by Mr. Ashwin Chabra, titled Beyond Markowitz, a comprehensive wealth allocation framework for individual investors. Now, Mr. Chabra was a vice president at Merrill Lynch for private investors or wealthy investors. Now, to cater to these private or wealthy investors, he had developed certain frameworks of how can these clients of their benefit from a framework which is suited for the individual investors, not just for the portfolio managers or fund managers. Now, based on the success of this research paper, because it has widely been resonated with a lot of public, he has written a book elaborating on this topic in the year 2011, titled The Aspirational Investor. Now, Mr. Anish Teli, who is the founder at QD Capital, based out of Mumbai, he has taken inspiration from some of these concepts which are there in this research paper, and he has written a book called as Mind Money Matters. It has focused specifically on the Indian investors, and he has added his own viewpoints or opinions on how can an individual investor in India construct their portfolios. So these are the references that I'm going to talk about in this video. All right, let's get into the video. So the research paper that I'm going to talk in detail is Beyond Markowitz. Now, if you have to understand what is this research paper about, we first need to know what was Markowitz's modern portfolio theory and why did it successfully run for 45 years, because the Markowitz theory was published way back in 1958 and it was accepted as universal truth for almost 45 years till 2005, only when Ashwin Chabra had published this wealth allocation framework. Now, so we need to see what was MPT or modern portfolio theory and its limitations, as in why it could not be a robust theory, and hence the new research paper, which is Beyond Markowitz. So let's spend a couple of minutes on modern portfolio theory. To drive home this point, I'll show a simple visualization of two assets. So modern portfolio theory says that let's say you have two assets and each of these assets have different return and risk profiles. So this space is a return and risk space. On the y-axis, you have returns, and on the x-axis, you have risk or standard deviation or volatility. Now you have two assets, A and B. Now asset A is in red color. It has a returns of 19% annual, and it also has a risk of 23%, a high risk, high reward kind of an asset. And in asset B, you have returns of around 15% with a risk of 17%, a low risk, low reward kind of an asset. Now, what happens when you combine these two assets, or when you are allocating amongst these two assets in some proportion of weightages? Now, let's assume that these two assets are fully correlated, meaning they have a correlation coefficient of 1. Now, if you have a correlation coefficient of 1 like this, and when you alter or differ the weights, you see that the portfolio lies in a straight line between these two. So if you are combining two assets having two different risk reward profiles and vary the weightage, then you're going to get a portfolio, a resultant portfolio, which falls within the straight line connecting these two assets. So that's the simple way of explaining modern portfolio theory. But there's more to it, more twist to it. Now let's assume that the correlation coefficient between these two assets is not 1, but it is, let's say, somewhere around 0, meaning they are uncorrelated. Then this curve becomes like this, a parabola, hyperbola. It doesn't remain a straight line. So what we see is that if the two assets are uncorrelated, then by combining these two assets in different weighing proportions, then we're going to get a resultant which is having even lesser risk than its two constituents. So combined let's say the asset A has a risk of 23% and asset B has a risk of 17%. The combination of these two assets when they are uncorrelated is now at 13%, way below than these two assets and at a decent return, which is above asset B but less than asset A. Now, if you vary the weighing composition between these two assets, you can also improve the returns with this similar risk profile. So that was the whole essence of Markowitz's modern portfolio theory, that if you are having two assets, and if these two assets are either uncorrelated or negatively correlated, by weighing by weighing different proportions between these two assets, you can get a resultant portfolio which is even superior and has a better risk reward ratio. So what we are essentially trying to do is we're combining two assets in the risk reward space and trying to get a portfolio which falls on the top left quadrant. Now, this might be something similar what you have earlier seen in when we've shown different kind of factor indices, right? So that's the same thing that we did. We combined low vol portfolio with the momentum portfolio, thereby getting somewhere in this quadrant of high return to low risk reward quadrant. So that's the whole essence of modern portfolio theory. That is to diversify between two different assets which are less correlated or no correlated, and you get a higher risk reward ratio. And what should be the composition between the different weights was dependent based on different risk appetite. Now, one component or one asset can be equity, other can be debt. One asset can be equity, other can be gold. Now, based on the users or the investors' risk appetite, the fund managers or the wealth managers used to allocate between these two assets and give a recipe for an investor to invest. So that was the whole essence. Now, if you see, the limitation for this is that only those assets where we can know their historical return or historical risk and also the correlation between different assets, we'll be able to make a calculated assessment or judge of how do you allocate between different assets. Now, let's say if you bring in assets which do not have these historical data, or even if, let's say you don't even know how to even calculate. For example, you bring in a residential home, or you bring in your business that you run. Now, let's say you have inherited that business, or you've inherited this property, or you've purchased this property or your land. Now, how does this fit into this modern portfolio theory? Because you do not know what is the return or risk expected from it, and how does it correlate with different of these assets. So that was one challenge or limitation. Now, the second limitation that modern portfolio theory assumes is that every investor is optimizing only for one singular function, which is the risk-adjusted returns. Now, if you ask anyone that, let's say after 20 years of investing, what was the most satisfactory thing that you have achieved? And the investor would say that I've been successful. I was able to lead a happy life, a great family and all, but no one would say that I was successful in getting a Sharpe ratio of 1.9 for the last 20 years. And I was able to beat the Nifty 50 benchmark by 2 percentage points. This is something that a fund manager or a wealth manager would say, not a normal investor. Our investors, like a DIY investor, their goals are different. Their goals are not simplistically centered around the Sharpe ratio alone. So that's the second limitation, that it is assuming that every investor is optimizing for only one particular global optima. Rather, the research paper proposes that every investor is actually optimizing for three local maximas or three local optimas. Now, again, these three local optimas that I'm going to talk about are based on the research, psychological research done by Daniel Kahneman and Tversky. Kahneman is the gentleman who has won Nobel Prize and has also written a great book called Thinking Fast and Slow. Now, based on this findings, Avnish Chopra proposes that the first optima every investor would want to optimize is to ensure that they are not going to the path of financial ruin. Now, in the pursuit of generating wealth, creating value, the investor should ensure that they are not taking excessive risk and putting themselves and their family jeopardizing their wealth and going down the hill. So at the minimum, they should ensure that their capital is protected. So that's the first local optima. Every investor would try to optimize. So you want to safeguard your fortress. That's the first. And second local optima that every investor would want to optimize is to at least ensure that you are able to maintain your lifestyle. If you're able to beat the inflation and you're managing the lifestyle of whatever you're having right now for a sufficiently long period of time, that's the second optima which I've already unlocked. Now, the third optima that every investor would want to have is to take a meaningful bet and aspire to move up the wealth ladder. Now, this is where the modern portfolio theory comes into the picture. Now, you see that there are three aspects or three goals that this research paper proposes instead of having just one singular goal. Let's see one by one. The first one is at the very outset, it should be clear that every household, regardless of its current wealth, should make sure that it does not move leftwards, that is, decrease its wealth percentile. Second, at least keeps up with its wealth group or its peers. And thirdly, aspires to move rightwards, increase its relative wealth standing. Now, you notice that in the first goal, we want surety. In the second goal, we want a good probability. And in the third goal, we want some possibility. Now, if you actually just sit back and think about it, it makes sense. Because let's assume that you are an investor and you are invested just before the COVID crash during February 2020. And you have seen a fall of 30%. Now, when you see a fall of 30% on your portfolio, and you feel that at that point of time in March 2020 that I've taken unnecessarily excessive risk, I should have stayed away from the equity, and I would have at least held on to my capital, whatever I've earned so far, and protected the capital. Now, again, fast forward to 2021 October, where the markets were running crazily. At that point of time, you would have felt that looking at your peers and your neighbors that I should have invested even more. I should have taken loan and maybe invested even better. I would have gotten even higher returns. The same person thinks in a different way at different times. At one point of time, the investor thinks about safety. And at the other end, he thinks about aspiration. So the human mind is not simplistic. It always has these dual demands of safety and aspiration. Now, a singular function or a single utility function cannot solve for this. And hence, the conventional modern portfolio theory framework does not accommodate this. And to address this, they have proposed this dual or non-concave utility function, which addresses the duality of safety, aspiration, and ensuring that the status quo is also maintained. Now, let's take a look at how this can be visualized. Let's say in the first local optima, where we said that we want to protect the capital, right? Instead of looking at it as wealth allocation, in fact, the research paper also, the Avnish Chabra proposes that think of it as risk allocation. Now, to optimize for the first local optima, see what amount of money or wealth that you would want to park in this bucket where you want surety. The only singular function objective is to ensure that whatever you've already created stays the same way, so that you're not taking excessive personal risk. So this particular risk bucket is called as personal risk. Now, within this personal risk bucket, please note that the objective here is to protect. If you are able to get more than 0% returns at the least, and at the maximum, if you're able to get at least inflation level returns, we are happy. So that's all we aspire to in this bucket. So an investor, some part of any investor's portfolio should fall under this bucket of maintaining or protecting their capital. The second part is the aspirations or the goals will be to ensure that you're able to beat the inflation. If you're able to beat the inflation at the least, and if you're able to get an excessive alpha over and above the inflation, that is bonus. So the objective here is not to generate alpha, but at least to ensure that you're able to get the market level risk. And how do you beat the inflation? The best way, the proposal is that when you have exposure towards equity, the quality companies, the large cap companies that are running the economy, and if you are investing in the economy through an exposure of, let's say, an index fund or ETFs or mutual funds which are investing in quality companies of the economy, you are able to take on the objective of beating the inflation. So they term this second bucket as market risk. So where you're taking the risk which is equivalent to what the market takes up. Now, the third level or the third optima is called as aspirational risk. Now here you're taking the risk of trying to ensure that you are moving up the wealth ladder. Here is where the excessive or not excessive, the right word would be disproportionate risk is taken. Basically, you are risking, let's say, X amount of money to get X plus Y kind of returns. Now, you can take exposure to these disproportionate returns through various assets, equity being one, concentrated bets. You can also take it through plots, lands, maybe an ESOPs. You might have your own business. You might invest in your PMS, or it can be, you can be an angel investor. There are a whole variety of ways where you can get the exposure of disproportionate risk. The objective here is definitely to beat the market returns and see if you can get as we call the multi-bagger kind of returns. So in each function, the mindset has to change. In the first optima, you are only concerned that you are beating 0%. In the second bucket, you're only concerned about beating the inflation. In the third criteria, in the third bucket, you are concerned about beating, not only beating the market, but also taking the risk in such a way that you are getting a multi-bagger kind of returns. Now, a same investor has to switch their minds when they are thinking about these three optimas, and hence the wealth also should be distributed among these three different buckets. I'll show you how do you distribute, or what are the assets that you can get exposure to, where you can park in each of these three different types of assets. So for that, I'll just show a Figma file where, let's say, you have three different risk buckets that you want to take, and these are all the different types of assets that are at your disposal. Let's moment assume that the investor has all these assets with him. Now, where do they fit under each of these buckets? Now, for liquidity, I've marked all these assets in similar color. And let's say for residential, I've marked these assets in similar color. For equity, I've marked all these in similar color. And these are gold. So that's how I've marked in different color. Now, what the research paper says is that at the very least, the first local optima should be satisfied, where you are not taking excessive risk and you're protecting your assets, or you're protecting your family. So let's say the insurance that you have falls under this personal risk. So if you already have an exposure, you already taken medical or term or whatever insurance that you have, that falls under this bucket. So you're already protecting the downside. And let's say you also have some cash, that also falls under this personal risk, where you already are protecting to a certain extent. If you also have a residential home minus the liability or the mortgage, this also falls under the personal risk, where you're able to fortify your fortress. Now, these three are the combination that you have, are what you have built so far. And if something bad happens, you always fall back onto this. Let's say, let's add gold also to this. Now, this, when you combine all these four different assets in the personal risk, the first utility function or local optima is already optimized, where you have gold, a bit of cash, a residential home where you can call it as yours, and you're safely covered with insurance. And the first level is unlocked. The second level is, let's say, in the market kind of a risk. The best way to take market kind of a risk, I think this again has been proposed even in the book Mind Money Matters by Anish Tele, is the best way to take market risk is by owning the market. That is index fund. Any index fund which has exposure to large cap, especially, is sufficient to beat the inflation over a longer period of time. So the index funds are the right assets that you want to have allocation in this bucket. And let's say other aspects that you want also to have to balance it. Maybe gold ETFs can have a place in this. REITs also can have a place in this. You notice that a similar kind of an asset, like let's say a land or residential, can have its utility in different buckets. It might be a same asset, but can work in a different bucket. Let's say the fixed deposits or bonds can fall under this. Maybe fixed deposits can come here. The bonds are, let's say, are there here. So a well-diversified portfolio like this might be able to beat the markets. Now, what are the allocations? How do you want to choose? Are all dependent on the individual, but these are the core assets that you have at your disposal to ensure that you are able to beat the markets, or at least have the returns similar to the markets. If not beat the market, just get the returns as good as markets. Now, you also know the S&P SPWA's research report that 70% of the active fund managers are not even able to beat the benchmark. So if the active fund managers themselves are not able to beat the benchmark, who are we as normal DIY investors? So our first objective is just to get the returns as out of market. And the great way is to index funds. Now, in the third bucket, where we want to aspire to move up the wealth ladder, this is where we take the disproportionate risk. And in here again, Anish Tale in his book Mind Money Matters suggests that factors are a great way. Factor indices, exposure to having multi-factors, maybe one or two, is a great way to ensure that you beat the markets in a systematic fashion for a longer period of time, and you are able to generate alpha or higher returns than what you anticipate. If, let's say, you have your own business and you believe that your business has a lot of potential to scale even further rapidly and can alter your wealth position, then that falls under this bucket. And let's say you also are a value investor and you've taken some concentrated stock bets, that also falls under this bucket. If you are working in a startup or maybe an organization where you have some ESOPs And these ESOPs, let's say if you put in great work and if the company really does well, that again can change your lifestyle. That also comes under this bucket. If you also have taken exposure to a couple of land, real estate, or plots, that also falls under this bucket. That gives you a ticket to move to the next ladder. But there's one asset which is still left that is called as human capital. In the research paper, they say that human capital is nothing but the effort that we put in. Let's say you are an employee or you have uh, uh, still a lot of period left for you to work. Then that is the human capital that you are putting. Now, this human capital can be put in this bucket, or if let's say your human capital is used to greatly improve your business, then maybe it can be put in the aspirational risk. But for safer side, let's put that you are in this bucket. Now, this is how you can allocate. If you already have your different allocations, or if you already have different assets, by doing this exercise of allocating into different buckets, already clears your mind of where to focus on. Now let's, for a moment, see that this investor has an excessive focus on this bucket. And for a moment, you assume that the weightage in this is less. Then they can dilute some part of this and maybe focus on this. Now, the allocation percentage between personal risk, market risk, and aspirational risk, it has been provided, but again, it varies based on individual person to person. The risk appetite, the cash flows are the two main considerations one need to take a look at, and also the longevity of work life. These three are the considerations. And the best way to judge is to do an introspection, and maybe if not possible, reaching out to a financial advisor, because financial advisors would day in and day out be seeing similar kind of cases with different profiles, and they'll be able to empathize with us and assess our situation even better and suggest how do we allocate in this fashion. If let's say you are a DIY investor who want to do it on their own, then the best way is to do an introspection and see where are you over indexed. Our gut feel itself will say that maybe, or we are over indexed unnecessarily on being defensive, on putting too much on the personal side of risk, and we are not taking sufficient aspirational risk, and maybe we can put some amount of money on the aspirational side of it. Or we might be having too much only on the market side of it, but we do not have anything on the personal risk. That changes can be done based on one's own discretion. So there's also another aspect that is covered in the research paper that talks about, at least, or gives you a glimpse where to focus on or which bucket to focus more on. It depends on your journey or path. Let's say if you're very close to the minimum wealth level, then fortifying your personal risk is the most important aspect. If let's say you are decently covered well enough from the personal risk, if you're somewhere in between, then having the market level risk, so that at least in the worst case you're able to maintain your lifestyle, that should be the priority. If you're somewhere close to achieving or at least in the midway between the market risk and your goal, then taking the aspirational risk is a great way, because you now have the luxury. Even if you fall down a bit, also you still be able to maintain that lifestyle, and you're still way off from the personal risk. So you could take more of aspirational risk as and when you move up the ladder. Now, in this research paper, they also suggested a couple of allocation percentages, at least in the broad range sense. And this has to be taken with a pinch of salt. These cannot be applied directly to individual investors themselves, because this research was done 20 years back, that too in US. I don't know if it works in the Indian context, if these same allocations. It is better to do self-introspection or contact a financial advisor, but at least we now have a sense. Let's see what all strategies that they propose. The first thing is, let's say you're a conservative investor. Then, as we have seen, the focus will be more on fortifying your the personal risk of building your assets first, or building your hard assets, or maybe property, or taking the insurance, and having sufficient gold or cash bank balance is the major thing, so that you don't falter back, and taking a decently enough exposure to market risk and some amount in aspirational risk. Let's say if you're a wealthy, affluent investor, in that case, what happens is, for the wealthy or affluent investors, the need for personal risk is somewhat less, and they can take a majority of market risk and also a good chunk of aspirational risk. Now, then there are other strategies also. Let's say someone who is close to getting retired, then the proposal is, since now anyhow you're close to getting retired, and the aspirational risk also is now very less, because you've already been closer to the time period, at least, of achieving the goal. In that case, trying to maintain whatever you have earned so far is the utmost importance, and hence the annuity strategy suggests you have a majority of the money parked in the safe deposits, and some money which is able to maintain your lifestyle, and very little in the aspirational risk. Maybe if you want to pass on some of these generational wealth and some generational level bets, or maybe a plot or some great stocks, these can be purchased in the aspirational risk. Now, the There's another approach also for risk takers. It is also called as barbell strategy. You might have also seen this barbell strategy in one of our investing methods. That is to invest in the extremes and be light in the midway. So if you're a risky investor who has sufficient longevity of work life, then at the same time ensure on fortifying your downside, and also take excessive risk on the upside, so that since you anyhow have the salary that will be coming, and you have, let's say, next 20-25 years of salary that you're going to get, so even if you're not able to click some of these aspirational goals, you still have long time to try out and take more and more bets and keep improving the aspirational risk. Again, this is suitable for someone who's younger in the age, has a longevity in terms of work life, and is also a risk taker. Well, let's summarize what we have learned so far. In the research paper, it talks about that there's no one single function that serves every investor's purpose. There are three functions that serve. First is to protect or fortify your downside, and at the same time, aspire on the upside, and also ensure that you are staying in the current, able to maintain the current lifestyle. So these are the three different goals a person or investor need to juggle between. Now, what is the percentage allocation between these three buckets will be left to the discretion of the investor, and maybe while having a consultation with the financial advisor. Now, you also seen a couple of examples of how can you achieve this. And from the book of Mind Money Matters, we have seen that indexing is the best way to get the market risk, and factoring is the best way, or exposure to factor is the best way to get aspirational risk. Now, these were the major points that have been covered. Now, let's come back to the portfolio that I've been following. So you see that in the last video, I've shown that there's a core which I have, and then there are two satellite. One satellite is on DIY momentum, and the other satellite is a momentum and low vol ETF. Now, there are other aspects also, as I mentioned, in the aspirational risk you can take. I'm only considering or talking about the equity part, where you can take some concentrated stock bets, or leave aside the other aspects, which are, let's say, of plots, which are not about markets. Now, the aspect of deep value or cyclical bets is something which not everyone can do really well. Now, if you're a great stock picker who understands or knows value, then it might work for you. But majority of the investors, factors will work, because factors have been seen in history. They have been seen to be replicated. They're robust, and hence it becomes easy for someone to apply or to get excessive risk or excessive returns over and above the market, for someone to follow or get hold of aspirational risk. So that's the major takeaway that I had from the book Mind Money Matters. Now, in this portfolio of mine, as I mentioned, these are the two satellite portfolios. Or satellite portfolios are nothing but what you can call them as the aspirational risks manifested in this fashion. Satellite is what we see, and core portfolio for me is the same as Nifty 50, Nifty Bs is what majority. I think there are again a lot of definitions of what can be a market risk, a better index that you can have. Again, I do not have any right or wrong answer per se. It is up to your discussion. You can choose. And finally, I want to leave with one final thought, that whatever is being presented is a reflection of my own opinion on what I believe is a decent enough wealth allocation framework. And I might be completely wrong. So you can keep out or stay. I'm not a cop. I'm just a sign. Thanks a lot, guys. Have a nice day.